Good morning, Bill here with another edition of the Metals Minute. This is Wednesday, September the 8th, 2021. Well, we've had a lot of stuff going on this week. We've had an incredible smash down at the beginning of this week. Had really little to do with gold and silver other than they're becoming more and more a viable alternative. And the Treasury needed to issue lots of bonds, and so they don't like to compete with gold and silver, so there was an incredible amount of future sales issued as soon as the market opened, and that served to drive the price down. They've already recovered quite a bit from that, but there was also pressure from the bond collapse, the major entity in China that was going down. It threatened the whole financial system. So they've trying to get a lid on that as best they could. And one of the first things they always try to do is smash down gold and silver to remove some of the competition. But what's happening in the meantime is a lot of countries, a lot of central banks have been purchasing gold hand over fist. And as we like to recommend to people, it's always good if you can also take advantage of that. Whenever we see these price smashes, it's a great time to add to our precious metals portfolios. And so there's other things happening that we want to talk about, one of which is the president just announced that he wants to see electric capacity, 45% of it come from solar. Well, right now only 2 to 3% is from solar, and even if we only move to 10% of our electric power production from solar, that would create an increased demand of 200 million ounces of silver. So this is extremely bullish for silver, even if they don't hit their 45% target. Even if they just make it to 10 or 15, it's a tremendous demand increase for silver. So that bodes well. There's also problems in the financial sector. We've reached a point in the high yield bond sector. Now let's talk about what high yield bonds are. Those are, another term is junk bonds. They are the riskiest type of bond that's in the investment world today, except for those that are on the fringes that rarely do people want in the mainstream. But high yield bonds are a major category of investment, and typically people accept a higher risk to get the higher yield. The problem is now 85% of high yield bonds earn a negative real rate. We've talked before about how treasuries are earning a negative yield rate all throughout the treasury yield curve. The yields are lower than the current rate of inflation. Well, usually when someone accepts higher risk for a high yield bond, they expect to be a higher yield paid to them. But right now, 85% are paying a negative real yield. At the beginning of the year, it was less than 4%. But inflation has ramped up. The ECB is trying to talk about tapering their bond purchases. Meanwhile, we're at a 10-year high for the rate of inflation. So it's not likely that they're either in Europe or here in the United States will they be able to do much tapering, even though inflation is taking off. We also see the signs of stagflation beginning to take effect, and I have encouraging news. That's not a good thing that we have stagflation, but what is encouraging is that the best performing assets during periods of stagflation in our nation's history has been gold and silver. Gold even more so than silver. This time it might be more equally weighted because we do have all the increased demand coming from government edict for silver. So we may see both of them do really well this time around. There's a lot more coming up, and we look forward to seeing you again next week. Thanks for tuning in.